Chapter 30 International Public Sector Accounting Standards IPSAS. Group A IPSAS 1, 2, 3, 4, 11, 12, 13, and 14. Contents: 1. Purpose. 2. Introduction. 3. Objectives of the IPSAB. 4. Membership of the IPSAB. 5. Due process. 6. Presentation of financial statements. 7. Cash flow statement. 8. The effect of changes in foreign exchange rates. 9. Construction contracts. 10. Inventories. 11. Leases. 12. Events after the reporting date. 13. Chapter review. 14. Worked examples. International Public Sector Accounting Standards IPSAS. Group A IPSAS 1, 2, 3, 4, 11, 12, 13, and 14. Purpose. After studying this chapter, readers should be able to A. Explain what IPSAS are and the relevance of the International Public Accounting Standards Board, and B. Discuss the provisions of IPSAS 1, 2, 3, 4, 11, 12, 13, and 14 respectively. Introduction. The IPSASB, formerly Public Sector Committee (PSC), is a board of IFAC formed to develop and issue under its own authority International Public Sector Accounting Standards IPSAS. IPSAS are high-quality global financial reporting standards for application by public sector entities other than government business enterprises (GBEs). Objectives of the IPSASB. The main objective of the IPSASB is to serve the public interest by developing high-quality public sector financial reporting standards. The IPSAS are the authoritative requirements established by the authoritative publications, including studies, research reports, and occasional papers that deal with particular public sector financing reporting issues. Membership of the IPSASB. The members of the IPSASB are appointed by the IFAC board to serve on the IPSASB. The IPSASB comprises 18 members, 15 of whom are nominated by member bodies of IFAC, and 3 of whom are public members. Public members may be nominated by any individual or organization. In the public sector financial reporting, accounts are appointed to the IPSASB. These observers have the privilege of the floor but are not entitled to vote. Due process. The IPSASB adopts a due process for the development of IPSAS. They are provided the opportunity for comment by interested parties, including IFAC member bodies, auditors, preparers, including finance ministries, standard setters, and individual are priorities. The IPSASB's due process for projects normally, but not necessarily, take the following stages. A. Study of national accounting requirements and practice and exchange of views about the issues with national standard setters. B. Consideration of pronouncements issued by 1. The International Account Standard Board (IASB). 2. National standard setters, regulatory authority, and other authoritative bodies. 3. Professional accounting bodies. And 4. Other organizations interested in financing reporting in the public. C. Formation of steering committees (SC). Project Advisory Panels (PAPS) of subcommittees to provide input to the IPSASB on a project. D. Publication of an exposure draft for public comment, usually for at least 4 months. This provides an opportunity for those affected by the IPSASB's pronouncements and are finalized and approved by the IPSAS. The exposure draft will include a basis for conclusion. E. Consideration of all comments received within the comment period on discussion documents and exposure drafts, and to make modifications proposed standards as considered appropriate in the light of the IPSASBs. F. Publication of an IPSAS which includes a basis for conclusions that explains the steps in the IPSASBs due process and how the IPSASB reached its conclusions. The adoption of IPSAS by governments will improve both the quality and comparability of financial information reported by public sector entities around the world. The IPSASB recognizes the right of governments and national standard setters to establish accounting standards and guidelines for financial reporting jurisdictions. The IPSASB encourages the adoption of IPSAS and the harmonization of national requirements with IPSAS. Financial statements should be described as complying with IPSAS only if they comply with any requirements of each applicable IPSAS. Provisions of each IPSAS. IPSAS 1. Presentation of financial statements. Introduction. The aim of this standard is to prescribe the format in which general purpose financial statement should be presented so that it can be compared with the entity's financial statements of previous periods and with the financial statements of other entities in the same sector. Components of financial statements. The standard lists the following as a complete set of financial statements. A statement of financial position. B. A statement of financial performance. C. A statement of changes in net asset or equity. D. A cash flow statement. Information to be presented on the face of the statement of financial position. The standard provides the following information should be presented on the face of the statement of financial position. A. Property, plant, and equipment. B. Investment property. C. Intangible assets. D. Financial assets, excluding amounts shown under E, G, H, and I. E. Investments accounted for using the equity methods. F. Inventories. G. Recoverable from non-exchange transactions, taxes, and transfers. H. Receivables from exchange transactions. I. Cash and cash equivalents. J. Taxes and transfers payable. K. Payables under exchange transactions. L. Provisions. M. Financial liabilities, excluding amounts shown under J, K, L. N. Non-controlling interest presented within net assets and equity. And O. Net asset or equity attributable to owners of the controlling entity. Information to be presented on the face of the statement of financial performance. As a minimum, the statement should include line items that present the following amounts for the period. A. Revenue. B. Finance costs. C. Share of the surplus or deficit of associates and joint ventures accounted for using the equity method. D. Pre-tax gain and loss recognized on the disposal of assets or settlement of liabilities attributable to discontinuing operations. And E. Surplus or deficit. IPSAS 2. Cash flow statement. Introduction. This standard requires the presentation of information regarding the historical changes in cash and cash equivalents of an entity by preparing a cash flow statement. The statement classifies periodic cash flows into operating, investing, and financing activities. The IFRS on which the standard is based is IAS 7 on cash flow statement. Classification of cash flows by activities. A. Cash flow from operating activities in a public sector entity are indicators of the extent to which such entity is financed by taxes or sale of goods and services. Examples of such cash flows are as follows. 1. Cash received from taxes, levies, and fines. 2. Cash received from sales of goods and provision of services by the entity. 3. Cash received from grants or transfers and other appropriations or other budget authority made by the central government or other public sector entities. 4. Cash payments to suppliers of goods and services. 5. Cash payments to other public sector entities. 6. Cash received from royalties, fees, commissions, and other revenue. 7. Cash payment to and on behalf of employees. 8. Cash received and payments of an insurance entity for premiums and claims, annuities, and other public benefits. 9. Cash payments of local property taxes or income tax where appropriate. 10. Cash received and payments from contracts held for dealing or trading purposes. 11. Cash received or payments in relation to litigation settlements. 12. Cash received or payments from discontinued operations. It should be noted, however, that IPSAS 2.27 directs that cash flows from operating activities are reported using either the direct method recommended by IPSAS board or the indirect method. IPSAS-B recommended direct method so as to provide a reconciliation of the surplus or deficit from ordinary activities, that is, statement of financial performance, with the net cash flow from operating activities, that is, cash flow statement, either within the cash flow statement or the notes. B. Cash flow from investing activities are cash received or payments to acquire resources that are intended to contribute to the entity's future public service delivery. IPSAS 2.25 gives the following as likely items that could be classified as such activities. 1. Cash payments to acquire property, plant and equipment, intangibles and other long-term assets. Payments relating to capitalized development costs and self-constructed property, plant and equipment are also included. 2. Cash received from sale of property, plant and equipment, intangibles and other long-term assets. 3. Cash payments to acquire equity or debt instruments of other entities and interest in joint ventures, other than payments for those instruments considered to be cash equivalents and those held for dealing or trading purposes. 4. Cash received from sale of equity or debt instruments of other entities and interest in joint ventures other than receipts from those instruments considered to be cash equivalents and those held for dealing or trading purposes. 5. Cash advances and loans made to other parties other than advances and loans made by a public financial institution. 6. Cash received from the repayment of advances and loans made to other parties other than advances and loans made by a public financial institution. 7. Cash payments for future contracts, forward contracts, open contracts, and swap contracts, except when the contracts are held for dealing or trading purposes, or the payments are classified as financing activities. 8. Cash received from future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes, or the payments are classified as financing activities. Cash flow from financing activities show future claims by providers of capital to the entity. Example of such valuable information as contained in Ipsas 2.26 are as follows. A. Cash proceeds from issuing debentures, loans, notes, bonds, mortgage, and other short or long-term borrowings. B. Cash repayments of amounts borrowed. C. Cash payments by lessee for the reduction of the outstanding liability relating to a finance lease. Note that A. Public sector entities are required to report separately all major classes of gross cash received and gross cash payments arising from investing and financing activities, unless the standard expressly permits reporting cash flows on a net basis in accordance with Ipsas 2.32 to 35. B. Cash flows arising from transactions in a foreign currency are recorded in the entity's functional currency by applying to the foreign currency amount the exchange rate between the functional currency and the foreign currency at the date of the cash flow. C. Cash flows from interest and dividends received and paid are disclosed separately and classified in a consistent manner from period to period as either operating, investing, or financing activities. D. Cash flows arising from taxes on net surplus are classified as cash flows from operating activities unless they can be allocated to specific investing or financial activities. E. The aggregate cash flows arising from acquisitions or disposals of subsidiaries or other entities are presented separately and classified as investing activities. F. Ipsas 2.56 requires that entities disclose the components of cash and cash equivalent and to present a reconciliation of the amounts in their cash flow statement with the equivalent terms reported in the statement of financial position. Ipsas 3. Accounting policies, changes in accounting estimates and errors. Introduction. The standard is designed to set out the criteria for selecting and changing accounting policies, together with the accounting treatment and disclosure of changes in accounting policies, changes in accounting estimates, and corrections of errors. The standard gives the following definition among others. A. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. B. A change in accounting estimate is an adjustment of the carrying amount of an asset or a liability, or the amount of the periodic consumption of an asset, that result from the assessment of the present stations of and expected future benefits and obligations associated with information on new developments, and accordingly are not correction of errors. C. Prior period errors are omissions from and misstatements in the entity's financial statement for one or more prior periods arising from a failure to use or misuse of reliable information that 1. was available when financial statements for those periods were authorized for issue, and 2. could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Such errors include the effects of mathematical mistakes, mistakes in applying accounting policies, oversight or misinterpretation of facts, and fraud. D. Material omissions or misstatements. Items are material, or misstatement items are material if they could, individually or collectively, influence the decisions or assessments of users made on the basis of the financial statements. Materiality depends on the nature or size of the omission or misstatement judged in the surrounding circumstances. The nature or size of the items, or a combination of both, could be determining factor. Changes in accounting policies. According to the standard, A change from one basis of accounting to another basis of accounting is a change in accounting policy. B. A change in the accounting treatment, recognition or measurement of a transaction, event or condition within a basis of accounting is regarded as a change in accounting policy. The following are not changes in accounting policies. A. The application of an accounting policy for transactions, other events, or conditions that differ in substance from those previously occurring. And B. The application of a new accounting policy for transactions, other events, or conditions that do not occur previously or that were immaterial. Disclosure. The standard requires the following disclosure. A. When initial application of IPSAS is made and has effect on current, prior, or future periods. 1. The title of the standard. 2. When applicable, an event of transitional provision. 3. The nature of the change in accounting policy. 4. When applicable, a description of transitional provision. 5. When applicable, the transitional provisions that might have an effect on future periods. Others are the amount of adjustment by line item affected, and if retrospective application is impracticable, the circumstances for that, how, and from when the change applied. B. When a voluntary change in accounting policy is made and has effects on current, prior, or future periods. 1. The nature of the change in accounting policy. 2. The reasons why applying the new accounting policy provides reliable and more relevant information. 3. For current and prior period present to the extent practicable, the amount of the adjustment for each financial statement line item affected. 4. The amount of the adjustment relating to periods before those presented to the extent practicable. If retrospective application is impracticable, the circumstance for that, how, and from when the change applied. IPSAS 4. The effect of changes in foreign exchange rates. Introduction. This standard is meant to prescribe how public sector entities should account for foreign currency and how to translate financial statements into a presentation currency. More importantly, it addresses general issues such as the exchange rates to be used, on how the financial effects of changes in exchange rates should be accounted for in the financial statements. The IFRS on which the IPSAS is based is IAS 21 on the effect of changes in foreign exchange rates. Principal definitions in the IPSAS. A. Functional currency is the currency of the primary economic environment in which the public sector entity operates. The primary economic environment of an entity is the one in which it primarily generates and expends cash. B. Presentation currency is the currency in which the financial statements are presented. Scope of the standard. Public sector entities preparing financial statements under the accrual basis of accounting are required to apply IPSAS 4 on the following premises. A. In accounting for transactions and balances in foreign currencies, except for those derivative transactions and balances that are within the scope of IPSAS 29 on financial instruments, recognition and measurement. B. In translating the financial performance and financial position of foreign operations that are included in the financial statements of the entity by consolidation or by the equity method. In translating an entity's financial performance and financial position into a presentation currency. Functional currency concept. The following are the factors relevant for determining a public sector entity's functional currency. A. The functional currency may be changed only if there has been a change in the underlying transactions, events, and conditions. This is because the functional currency reflects the underlying transactions, events, and conditions which needs to be determined. B. The requirements of IPSAS 10 on financial reporting in hyperinflationary economics must be taken into account in the entity's financial statements when the functional currency is the currency of a hyperinflationary economy. Accounting for transactions in foreign currencies. IPSAS 4 is not as relevant to the public sector as the corresponding IFRS is for the private entities. In preparing financial statements, every public sector entity decides on its functional currency. When recognized foreign currency transactions are recorded in the functional currency by translating the foreign currency amount at the spot exchange rate between the functional currency and foreign currency at the date of the transaction. Reporting in subsequent period. In accordance with IPSAS 4.27, at each reporting date, A. Foreign currency monetary items are translated using the closing rate. B. Non-monetary items that are measured in terms of historical cost in a foreign currency are translated using the exchange rate at the date of the transaction. C. Non-monetary items that are quantified at fair value in a foreign currency are translated using the exchange rate at the date when the fair value was determined. Upon disposal of the net investment, the associated exchange differences are recognized in surplus or deficit, translating to the presentation currency. The provisions of IPSAS 4 is to grant a reporting entity the right to choose its presentation currency freely. Furthermore, the standard stipulated that every individual entity within the reporting whose functional currency differs from the presentation currency must be translated to the reporting entity's presentation currency. The financial performance and financial position of a public sector whose functional currency is not a hyperinflationary hyperinflationary economics currency are translated into another presentation currency as follows. A. Assets and liabilities for each statement of financial position presented, including comparatives, are translated at the closing rate at the date of the statement of financial position. B. Revenue and expenses in all statements of financial performance, including comparative information, are translated at the exchange rate ruling at the date of transaction. Exchange differences are recognized as a separate component of net assets or equity. C. In the case where the functional currency is the currency of a hyperinflationary economy, special rules apply for translating the financial performance and financial position into a presentation currency in accordance with Ipsas 4.48. Changing the functional currency. Public sector entities must apply the translation procedures applicable to the new functional currency prospectively as at the date of transition when changing the functional currency. Ipsas 11 Construction Contract. Introduction. The objective of this standard is to prescribe the accounting treatment of cost and revenue associated with construction contracts. Definition. A. Construction contract is a contract or a similar binding arrangement specifically negotiated for the construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of their design, technology, and function, or their ultimate purposes or use. B. Contractor is an entity that performs construction work pursuant to a construction contract. C. Cost plus or cost-based contract is a construction contract in which the contractor is reimbursed for allowable or otherwise defined costs, and in the case of a commercially based contract, an additional percentage of this cost or a fixed fee, if any. D. Fixed price contract is a construction contract in which the contractor agrees to a fixed contract price or a fixed rate per unit of output, which in some cases is subject to cost escalation clauses. Contract revenue. According to the standard, contract revenue should comprise A. The initial amount of revenue agreed in the contract, and B. Variations in contract work, claims incentive payments to the extent that 1. It is probable that they will result in revenue, and 2. They are capable of being reliably measured. Contract costs. Contract costs should comprise A. Costs that relate directly to the specific contract. B. Costs that are attributable to contract activity in general and can be allocated to the contract on a systematic and rational basis. And C. Such other costs as are specifically chargeable to the customer under the terms of the contract. Recognition of contract revenue and expenses. When the outcome of a construction contract can be estimated reliably, contract revenue and contract costs associated with the construction contract should be recognized as revenue and expenses, respectively, by reference to the stage of completion of the contract activity at the reporting date. In the case of a fixed price contract, the outcome of a construction contract can be estimated reliably when all the following conditions are satisfied. A. Total contract revenue, if any, can be measured reliably. B. It is probable that the economic benefit or service potential associated with the contract will flow to the entity. C. Both the contract cost to complete the contract and the stage of contract completion at the reporting date can be measured reliably. D. The contract cost attributable to the contract can be clearly identified and measured reliably so that actual contract costs incurred can be compared with PRAO estimates. In the case of a cost-plus or cost-based contract, the outcome of a construction contract can be estimated reliably when all the following conditions are satisfied. A. It is possible that the economic benefit or service potential associated with the contract will flow to the entity, and B. The contract cost attributable to the contract, whether or not specifically reimbursed, can be clearly identified and measured reliably. When the outcome of a construction contract cannot be estimated reliably, A. Revenue should be recognized only to the extent of the contract cost incurred that it is probable will be recovered, and B. Contract costs should be recognized as expenses in the period in which they are incurred. Recognition of expected deficit. According to the standard, construction contracts in which it is intended at inception of the contract that contract costs are to be fully recovered from the parties to the construction contract, where it is probable that total contract costs exceed total contract revenue. The expected deficit should be recognized as an expense immediately. Disclosure. The standard stipulates that an entity should disclose A. The amount of contract revenue recognized as revenue in the period, B. The method used to determine the contract revenue recognized in the period, and C. The method used to determine the stage of completion of contracts in progress. An entity should disclose each of the following for contracts in progress at the reporting date: A. The aggregate amount of costs incurred and recognized surpluses less recognized deficits to date. B. The amount of advances received, and C. The amount of retentions. The standard further states that an entity should present A. The gross amount due from customers for contract work as an asset, and B. The gross amount due to customers for contract work as a liability. IPSAS 12. Inventories. Introduction. This standard deals with the valuation and presentation of inventories in the financial statements in the context of historical cost system, the most widely adopted basis on which financial statements are presented. The standard does not deal with inventories accumulated under long-term construction contracts. It provides guidance on the determination of cost and its subsequent recognition as an expense, including any write-down to net realizable values. It also provides guidance on the cost formulas that are used to assign costs to inventories. The IFRS on which the IPSAS is based is IAS 2 on inventories. Contents of the standard. In accordance with IPSAS 12.9, inventories are assets A. Held for sale in the ordinary course of business, B. In the process of production for such sale or distribution, C. To be consumed in the production of goods or services for sale, D. In the form of materials or supplies to be consumed or distributed in the rendering of service, E. Held for sale or distribution in the ordinary course of operations. Inventories also include goods purchased for resale, such as merchandise, purchased by a retailer and held for resale, or land and other property held for sale. Inventories also encompass finished goods produced or work in progress being produced, and include materials and supplies awaiting use in the production process. Specifically, in the public sector, inventories also comprise goods purchased or produced by the entity that are distributed to third parties for no charge or for a nominal charge. An example will be children's books produced by a Ministry of Children Affairs for donation to schools. Other examples of inventories in the public sector given in IPSAS 12.12 include munitions, maintenances, materials, spare parts, strategic stockpiles, e.g., energy reserves or medicine in government hospitals and clinics, stocks of unissued currency, stamps, work in progress, and property held for sale. Exceptions from the provisions of IPSAS 12. IPSAS 12 applies for all inventories except for A. Work in progress arising under construction contracts, B. Financial instruments, C. Biological assets related to agricultural activity and agricultural produce at the point of harvest, D. Work in progress of services to be provided for no charge or nominal consideration directly in return from the recipient. IPSAS 12 does not apply for the measurement of the following inventories. A. Producers' inventories of agricultural or forest products, agricultural produce after harvest, and minerals and mineral products, to the extent that they are measured at net realizable value in line with well-established practices in certain industries. When such inventories are measured at net realizable value, changes in that value are recognized in surplus or deficit in the period of change. B. Inventories of commodity broker traders who measure their inventories at fair value less cost to sale. When such inventories are measured at fair value less cost to sale, changes in that value are recognized in surplus or deficit in the period of change. Measurement of inventories. Inventories should be measured at the lower of cost and net realizable value, except where IPSAS 12.12 applies. Inventories should be measured at the lower of cost and current replacement cost where they are held for A. Distribution at no charge or nominal charge, B. Consumption in the production process of goods to be distributed at no charge or for a nominal charge in line with IPSAS 12.17. Note that the cost of inventories comprises A. All cost of purchase, B. Cost of conversion, and C. Other costs incurred in bringing the inventories to their present location and state. IPSAS 12.18. The cost of purchase of inventories comprise A. The purchase price, B. Import duties and other taxes, C. Transport, handling, and other costs directly attributable to the acquisition of finished goods, materials, and supplies. Trade discounts, rebates, and other similar items are deducted in determining the cost of purchase. The cost of conversion of inventories in accordance with IPSAS 12.20 include full production related costs. The formula for arriving at the cost of conversion of inventories is as follows: direct cost plus fixed production overheads plus variable production overheads plus other costs equal to cost of conversion. Cost of conversion. The cost of conversion of inventories include costs directly related to the units of production, such as direct labor, a systematic allocation of fixed and variable production overheads that are incurred in converting materials to finished goods. Fixed production overheads are those indirect costs of production that remain relatively constant regardless of the volume of production. Examples of such costs are depreciation and maintenance of factory buildings and equipment, and the cost of factory management and administration. Variable production overheads are those indirect costs of production that vary directly or nearly directly with the volume of production, such as indirect materials and indirect labor. Other costs included in the cost of inventories only to the extent that they are incurred in bringing inventories to their present location and condition. Exceptions to the cost of inventories. The following costs are excluded from the cost of inventories and recognized as expenses in the period in which they are incurred. A. Abnormal amounts of wasted materials, labor, or other production costs. B. Storage costs, unless those costs are necessary in the production process prior to a further production stage. C. Administrative overheads that do not contribute to bringing inventories to their present location and conditions. D. Selling cost. Cost of inventories of a service provider. The cost of inventories of a service provider consists primarily of the labor and other costs of personnel directly engaged in providing the service, including supervisory personnel and attributable overheads. The cost of labor not engaged in providing the service are not included. Labor and other costs relating to sales and general administrative personnel are not included, but are recognized as expenses in the period in which they are incurred. Cost formula. When applying IPSAS 12.28, an entity should use the same cost formula for all inventories having similar nature and use to the entity. For inventories with different nature or use, different cost formulas may be justified. A difference in geographical location of inventories and in respective tax rules by itself is not sufficient to justify the use of different cost formulas. The cost of inventories other than those dealt with in IPSAS 12.25 should be assigned by using the first in first out FIFO or weight average cost formulas. The FIFO formula assumes that the items of inventory are sold on first come, first served basis. Consequently, the items remaining in inventory at the end of the period are those most recently purchased or produced. The weight average cost formula makes for the cost of each item determined by adding the purchase cost of a given item at the beginning of a period to the purchase cost of the item at the end of a given period, and divide by 2 to give a weight average cost. However, such average can be calculated on periodic basis or as each additional shipment is received, depending upon the circumstances of the entity. Net realizable value. This is the estimated selling price in the ordinary cost of operations less the estimated cost of completion and the estimated cost necessary to make the sale, exchange or distribution. Ipsas 13 Leases. Introduction. The aim of the standard is formulated to prescribe for lessees and lessors the appropriate accounting policies and disclosures to apply in relation to finance and operating lessees. Definitions. The following are some of the definitions provided by the standard. A. The commencement of the lease form. Commencement of the lease term. This is the date from which the lessee is entitled to exercise its right to use the leased asset. It is the date of initial recognition of the lease, that is, the recognition of the lease as appropriate. B. Contingent rent is that portion of the lease payment that is not fixed in amount but is based on the future amount of a factor that changes other than the passage of time, e.g., percentage of future sales, amount of future use, future prices, and future market rates of interest. C. A finance lease. The lease that transfers substantially all the risks and rewards incidental to ownership of an asset. Title may or may not eventually be transferred. Gross investment in the lease is the aggregate of A. The minimum lease payment receivable by the lessor under a finance lease, and B. Any unguaranteed residual value accruing to the lessor. Guaranteed residual value is 1. For a lease, that part of the residual value that is guaranteed by the lessee or by a party related to the lessee, the amount of the guarantee being the maximum amount that could, in any event, become payable. And 2. For a lessor, that part of the residual value that is guaranteed by the lessee or by a third party unrelated to the lessor that is financially capable of discharging the obligation under the guarantee. The inception of the lease is the earlier of the date of the lease agreement and date of commitment by the parties to the principal provisions of the lease. As at this date, A. A lease is classified as either an operating or a finance lease, and B. In the case of a finance lease, the amounts to be recognized at the commencement of the lease term are determined. Initial direct costs are incremental costs that are directly attributable to negotiating and arranging a lease, except for such costs incurred by manufacturer or trade lessors. The interest rate implicit in the lease is the discount rate that, at the inception of the lease, causes the aggregate present value of A. The minimum lease payment, and B. The unguaranteed residual value to be equal to the sum of 1. The fair value of the leased asset, and 2. Any initial direct cost of the lessor. C. D. A lease is an agreement whereby the lessor conveys to the lessee, in the return for a payment or series of payments, the right to use an asset for an agreed period of time. E. The liaise term is the non-cancellable period for which the lessee has contracted to liaise the asset together with any further terms for which the liaise has the option to continue to liaise the asset, with or without further payment, when at the inception of the liaise it is reasonably certain that the lessee will exercise the option. F. The lessee's incremental borrowing rate of interest is the rate of interest the lessee would have to pay on a similar liaise, or, if that is not determinable, the rate that, at the inception of the liaise, the lessee would incur to borrow over a similar term, and with a similar security, the funds necessary to purchase the asset. G. Minimum liaise payment are the payments over the liaise term that the lessee is or can be required to make, excluding contingent rent, costs for services, and, where appropriate, taxes to be paid by and reimbursed to the lessor, together with 1. For a lessee, any amount guaranteed by a lessee or a party related to the lessee, or 2. For a lessor, any residual value guaranteed to the lessor by the lessee, a party related to the lessee, or an independent third party unrelated to the lessor that is financially capable of discharging the obligation under the guarantee. However, if the lessee has an option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable for it to be reasonably certain, at the inception of lessee that the option will be exercised, the minimum lessee payments comprise minimum payment required to exercise it. G. Net investment in the liaise is the gross investment in the liaise discounted at the interest rate implicit in the liaise. H. A non-cancellable liaise is a lease that is cancelable only 1. Upon the occurrence of such remote contingency, 2. With the permission of the lessor, 3. If the lessee enters into a new lease for the same or an equivalent asset with the same lessor, or 4. Upon payment by the lessee of such an additional amount that, at inception of the liaise, continuation of the liaise is reasonably certain. I. An operating liaise is a liaise other than a finance liaise. J. Unearned financial revenue is the difference between the gross investment in the liaise and the net investment in the liaise. K. Unguaranteed residual value is that portion of the residual value of the liaise asset the realization of which by the lessor is not assured or is guaranteed solely by a party related to the lessor. L. Useful life is the estimated remaining period from the commencement of the liaise term without limitation by the liaise term, over which the economic periods of service potential embodied in the asset are expected to be consumed by the entity. Classification of liaise. These are classified into two: A. Financial liaise and operating liaise. A liaise is classified as a finance liaise if it transfers substantially all the risks and rewards incidental to ownership. A liaise is classified as an operating liaise if it does not transfer substantially all risks and rewards incidental to ownership. According to the standard, the following are the characteristics of a finance liaise of which the presence of any or combinations would normally lead to a liaise being classified as finance liaise. A. The liaise transfer ownership of the asset to the lessee by the end of the liaise term. B. The lessee has option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable, for it to be reasonably certain at the inception of the lease that the option will be exercised. C. The lease term is for the major part of the economic life of the asset, even if title is not transformed. D. At the inception of the lease, the present value of the minimum lease payment amounts to at least substantially all of the fair value of the lease asset. E. The lease assets are of such a specialized nature that only the lessee can use them without major modifications. And F. The lease asset cannot easily be replaced by another asset. Other indicators that individually or in combination would also lead to a lease being classified as a finance lease are: G. If the lessee can cancel the lease, the lessor's losses associated with the cancellation are borne by the lessee. H. Gains or losses from the fluctuation in the fair value of the residual accrued to the lessee, for example, in the form of a rent rebate. Equally, most of the sales proceeds at the end of the lessee. And I. The lessee has the ability to continue the lease for a secondary period at a rent that is substantially lower than the market rent. Disclosure. Lease in the financial statement of lessee. Finance lease. At the commencement of the lease term, lessees should recognize assets acquired under finance lease or as assets and associated lease obligations as liabilities in their statement of financial position. The assets and liabilities shall be recognized at amounts equal to the fair value of lease property, or if, however, the present value of the minimum lease payments, each determined at the inception of the lease, if this is practicable to determine. If not, the lessee's incremental borrowing shall be used. Lessees shall disclose the following for finance lessees: A. For each class of assets, the net carrying amount at the reporting date. B. A reconciliation between the total of future minimum lease payments at the reporting date and their present value. C. In addition, the entity shall disclose the total of future minimum lease payments at the reporting date and their present value for each of the following period: 1. Not later than 1 year. 2. Later than 1 year but not later than 5 years. And 3. Later than 5 years. D. Contingent rents recognized as an expense in the period. E. The total future minimum sublease payments expected to be received under non-cancelable subleases at the reporting date. And F. A general description of the lessee's material leasing arrangements, including but not limited to the following: 1. The basis on which the contingent rent payable. 2. The existence and terms of renewal or purchase options and escalation clauses. And 3. Restrictions imposed by lease arrangements, such as those concerning returns of net surplus, return of capital contributions, dividends, additional debt, and further leases. Lessee payment under operating years. Lease payment under an operating lease shall be recognized as an expense on a straight line basis over the lease term, unless another systematic basis is representative of the time pattern of the user's benefit. Lessees shall make the following disclosure for operating leases: A. The total of future minimum lease payments under non-cancelable operating leases for each of the following periods: 1. Not later than 1 year. 2. Not later than 1 year but not later than 5 years. And 3. Later than 5 years. B. The total future minimum sublease payments expected to be received under non-cancelable subleases at the reporting date. C. Lease and sublease payments recognized as an expense in the period, with separate amounts for minimum lease payments, contingent rent, and subleases payments. And D. A general description of the lessee's significant leasing arrangements, including but not limited to the following: 1. The basis on which contingent rent payments are determined. 2. The existence and terms of renewal or purchase options and escalation clauses. And 3. Restrictions imposed by lease arrangements, such as those concerning return of net surplus, return of capital combination, dividends, additional debt, and further leasing. Leases in the financial statements of lessors. Finance lease. Lessors shall recognize lease payments receivable under finance lease as assets in their statement of financial position. They shall present such assets as a receivable at an amount equal to the net investment in the lease. Lessors shall disclose the following for financial leases: A. Reconciliation between the total gross investment in the lease at the reporting date and the present value of minimum lease payments receivable at the reporting date. In addition, an entity shall disclose the gross investment in the lease and present value of minimum lease payments receivable at the reporting date, each of the following periods: 1. Not later than 1 year. 2. Later than 1 year but not later than 5 years. And 3. Later than 5 years. B. Unearned finance revenue. C. The unguaranteed residual values accruing to the benefits of the lessor. D. The accumulated allowances for the uncollectible minimum lease payment receivable. E. Contingent rent recognized in the statement of financial performance. And F. A general description of the lessor's material leasing arrangements. Lessor payment under operating lease. Lessor shall present assets subject to operating leases in their statement of financial position according to the nature of the assets. Leases payment under an operating lease shall be recognized as an expense on a straight line basis over the lease term, unless another systematic basis is representative of the time pattern in which benefits derived from the leased asset is diminished. Lessor shall disclose the following operating lease: A. The future minimum lease payments under non-cancelable operating leases in the aggregate and for each of the following periods: 1. Not later than 1 year. 2. Later than 1 year and not later than 5 years. And 3. Later than 5 years. B. Total contingent rent recognized in the statement of financial performance in the period. And C. A general description of the lessor's leasing arrangements. Sales and leaseback transactions. If a sale and leaseback transaction results in finance lease, any excess of sales proceeds over the carrying amount shall be immediately recognized as revenue by a seller lessee. Instead, it shall be deferred and amortized over the lease term. If a sale and leaseback transaction results in a finance lease and it is clear that the transaction is established as fair value, any gain or loss shall be recognized immediately, except that if the loss is compensated by future lease payments at below market prices. then it shall be deferred and amortized in proportions to the lease payments over the period for which the asset is expected to be used. For operating leases, if the fair value at the time of sale and leaseback transactions is less than the carrying amount of the asset, a loss equal to the amount of the difference between the carrying amount and fair value shall be recognized immediately. IPSAS 14. Event after the reporting date. Introduction. This standard is based on events, both favorable and unfavorable, that occur between the reporting date and the date when the financial statements are authorized for use. Assets and liabilities should be adjusted for events occurring after the reporting date that provide additional evidence to assist with the estimation of amounts relating to conditions existing at the reporting date, or that indicates that the going concern assumption in relation to the whole or a part of the entity is not appropriate. Process for authorization of the financial statements. The process involved in the authorization for issue of financial statements will vary depending upon the management or structure and procedures followed in the preparing and finalizing the financial statements, but the date of authorization for issue will normally be the date on which the statements are authorized for issue outside the entity. Exceptions to adjustment of events after reporting date. Adjustment to assets and liabilities are not appropriate for events occurring after the reporting date and the date on which the financial statements are authorized for issue. The fall in market value does not normally relate to the condition of investments at the reporting date, but reflects circumstances which have occurred in the following period. However, disclosure is generally made of events in subsequent period that represent unusual changes to the condition of assets or liabilities at the reporting date, e.g., the destruction of a major production plant by fire after the reporting date. Note also that events occurring after the reporting date that are indicative of conditions that arose subsequent to the reporting date are disclosed. If their non-disclosure would affect the ability of the users of the financial statements to make proper evaluations and take proper decisions, e.g., a major acquisition of another entity. Statutory requirements also may sometimes require the disclosure of certain financial information that occurred after the reporting date. Events occurring after the reporting date may indicate that the whole or part of the business of the enterprise ceases to be a going concern. A deterioration in operating results and financial position after the reporting date may indicate a need to consider whether it is proper to use the going concern assumption in the preparation of the financial statements. Reporting date. Reporting date means the date of the last day of the reporting period to which the financial statements relate. Types of events at the reporting date. In accordance with IPSAS 14.5, there are two types of events at the reporting date. A. Events after the reporting date that provide evidence of conditions that existed at the reporting date. These are adjusting events after the reporting date. B. Events after the reporting date that are indicative of conditions that arose after the reporting date. These are non-adjusting events after the reporting date. The authorizing body to authorize financial statements of government entity may be a parliament, national or state assembly, or a local council, Ipsas 14.7. The date of authorization for issue of financial statement will determine in the context of the particular jurisdiction the audit opinion is given on the basis of this financial statement, whether or not government announced intention requiring recognition. As adjusting events would depend upon whether they provide more information about the condition existing at the reporting date and whether there is sufficient evidence that they can and will be fulfilled. Usually, the announcement of government intentions will not lead to the recognition of adjusting events. Instead, they will generally qualify for disclosure as non-adjusting events. Accounting treatment of events after the reporting date. In line with Ipsas 14.10, an entity must adjust the amount recognized in its financial statement to reflect adjusting events after the reporting date. As an illustration, an adjusting event after the reporting date could be the settlement after the reporting date of a litigation, that is, court case, confirming that the entity had a present obligation at the reporting date. The entity adjusts any previously recognized provision related to this court case in accordance with Ipsas 19 on provisions, contingent liabilities, and contingent assets, or recognizes a new provision. The receipt of information after the reporting date indicating that an asset was impaired at the reporting date, or that the amount of the previously recognized impairment loss for that asset needs to be adjusted, also qualifies as an adjusting event after the reporting date. This is why the bankruptcy of a debtor, which occurs after the reporting date, usually confirms that a loss already existed at the reporting date on a receivable account and that the entity needs to adjust the carrying amount of the receivable account. The IFRS on which the Ipsas is based is IAS 10, events after the balance sheet date. Other disclosure obligations. Ipsas 14.26 states that an entity must disclose the date when the financial statements were authorized for issue and the body that gave such authorization. If another body has the power to amend the financial statement after the issuance, the entity must disclose that fact. Chapter review. This chapter discusses the evolution of the Ipsas, its membership and functions, the nature of the due process it follows in discharging its functions was also examined. The provisions of Ipsas 1, 2, 3, 4, 11, 12, 13, and 14 are discussed in turn.